Most stocks in the S&P 500 gained yesterday on the back of robust GDP data from the US. The US dollar rebounded, the euro fell on softening inflation pressures in the Eurozone. The Stoxx 600 index closed near a record high, and the European Stoxx 600's chief valuations remain attractive for investors around the world in this reflation setup. But could the European stocks extend their advance while the underlying economies in the Eurozone are slowing? Let's talk about that. So welcome. This is Swissquote's Daily Market Talk. So yesterday could have been worse, really. A more than 6% drop in Nvidia's stock price somehow limited the S&P 500 gains, but many stocks in the S&P 500 still gained at yesterday's trading session after the latest GDP update from the US came in better than expected by analysts and pointed that the US economy has grown 3% in the second quarter of this year, rather than 2.8% printed earlier. So it's more than the double of growth that was reported for the first quarter. Then the consumer spending almost doubled as well to 2.9% from 1.5% printed a quarter earlier. And the cool down in the GDP prices was less, but the core prices is more than expected by analysts. So all in all, the US economy rebounded in the second quarter, but the rebound didn't increase price pressures. In plain English, the data released yesterday tasted exactly how investors love it, with the additional sweet topping for the Federal Reserve rate cut expectations that, well, it has slowed in the third quarter of this year, but slowed from a higher mark. So there was actually reason to cheer the latest growth data from the US yesterday. The US 2-year yield rebounded just a little bit, but settled around the 3.90% mark. Then the US 10-year yield is at 3.86% level. The gap between the two has almost closed, which is a positive sign for those who actually expect a soft landing from the US, and the US dollar rebounded as a consequence. So the US dollar index recovered yesterday, as I said, on the back of this thinking that the Federal Reserve will start cutting its interest rates in September. Yes, but a 50 basis point cut is probably not needed straight away. But note that activity on Fed funds futures still gives 1/3 chance for a 50 basis point rate cut from the Fed in its September monetary policy meeting. And while the Fed is seen cutting its interest rates by 100 basis points from now to the end of this year, which is a scenario that actually implies that we will see a sharp slowdown from the current quarter onwards. And well, because the economic data shows an economic slowdown, sure, but remains far away from being alarming, at least for now, I actually believe that there is room for trimming the Federal Reserve rate cut expectations to between 50 or 75 basis point cut this year, and not 100 basis point cut, and that should justify a further positive correction in the US dollar against the peers, and a further rotation in the S&P 500 toward the growth-friendly and cyclical stocks, including energy and financials. Voila, that is my expectation in the light of the economic data and information that we have on hand today. Now, the rotation from technology to other sectors, which is also called the reflation trade, is believed to be positive, is believed to be bullish for the European stock markets. And indeed, capital inflows into the European stocks outpace inflows into the US markets in the second quarter of this year, precisely boosted by this expectation that the global interest rate cuts would be better for the reflation-friendly European stocks than their technology-heavy American peers, and also because the ECB cut its rates before the Fed. And the Stoxx 600 has been greatly benefiting from it till now. So yesterday, the index almost matched a record high level that was printed back in June this year, and remains quite attractive for international investors who actually look for interesting valuations to get away from highly valued and expensive American stock markets. And despite this year's rally, while the European Stoxx 600 index remains significantly cheaper than the ones across the Atlantic Ocean, in numbers, the Stoxx 600 offers a P/E ratio of around 14. That's well below than the S&P 500's average 21. Therefore, well, you would expect to see further inflows into the European stock markets. But the problem with that is that the interest rate cut expectations or interest rate cuts alone cannot infinitely attract investors to Europe, because Europe is slowing, its airline and luxury businesses are not doing so well. Then the Chinese woos have a significant negative impact on the most influential luxury brands. So much, in fact, that the British Burberry and EasyJet actually risk dropping out of the FTSE 100 index shortly. So we will probably know more about that subject by next week. And Bloomberg Intelligence actually revised its consensus EPS for the STOXX 600 down by 1.4% this year and 1.6% for next year. Over in the US, the technology stock investors are preparing for challenging times, yet the S&P 500's non-magnificent 493 stocks saw their growth expectations more than double and should see the benefits of the upcoming rate cuts from the Fed as well. And if the Fed can offer the US economy a soft landing, then there will be nothing to stop the US indices from outperforming their Western peers. So that's pretty much it for the stocks today. The US will release the latest core PCE index, the Federal Reserve's favorite gauge of inflation, expected to hint at a tiny rebound in July. Now, a stronger than expected read could lead to a further recovery in the US dollar. But even if that's the case, even if we see a strong number, stronger than expected number, the Fed, those are more interested in, well, jobs data these days than the inflation figure. So what would really change the game right now is strong jobs data from the US next week. That's the only thing that could alter the Fed, those expectations right now. But anyway, in the FX markets, the US dollar's latest rebound pulled the euro dollar lower at yesterday's trading session. Softer than expected German and Spanish inflation updates helped bringing the European Central Bank those back to the market as well. And note that inflation in Germany even fell below the European Central Bank's 2% policy target. So this combination of less dovish Federal Reserve expectations and more dovish European Central Bank expectations sent the euro dollar all the way down to 1.1070 level yesterday. The pair is consolidating near the 1.1075 level this morning at the time I'm talking here. The aggregate CPI data from the Eurozone will likely confirm the slowing price pressures in the Eurozone in a way to let the European Central Bank consider a clearer path for easing its monetary policy and lowering its rates. And I believe that the euro dollar could actually find a good reason to return below the 110 psychological mark, especially if we welcome a strong jobs data from the US next week. Elsewhere, while the dollar yen consolidates a touch below the 145 mark this morning amid a mixed bag of economic data released in Tokyo earlier today. Now, the latest data actually showed a slower rebound in industrial production, a bigger than expected slowdown in the Japanese retail sales, a larger than expected rise in its unemployment rate, and, well, a stronger than expected inflation during late summer, so between July and August. So we believe that ongoing price pressures in Japan will likely keep the Bank of Japan, well, inclined toward more monetary policy normalization. However, if economic fundamentals in Japan deteriorate further, then the Bank of Japan could quickly reverse course and extend support to the economy. And this would obviously hinder the Japanese yen's recovery and potentially also enhance carry trades. So this is all for this week. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again next week. And until then, good day trading and have a lovely weekend.